Welcome back to the Gold Standard. I'm here with Sasha Reyes, and this week the metals markets gave us a lot to work through.
An understatement is putting it mildly, Marcus. Gold posted a weekly gain of roughly 2.4%, touching 47.50 Thursday before settling near 47.23 Friday. Ceasefire headlines, a solid jobs report, Chinese central bank buying, all converging at once. That's the volatility we need to unpack.
And the important thing to understand is that the picture isn't clean. U.S.-Iran clashes kept resurfacing even as truce hopes lifted prices. We'll dig into what's actually driving gold right now and what technical support levels traders are watching.
Then, silver. On May 7th, USA Today tracked an 8.98% single-day surge to $80.32 an ounce. That's a 142% gain year over year. Does that make sense why traders are watching this so closely?
And here's why this matters. It's not just the price move. A U.S. regulator publicly stated the silver market is structurally broken. We'll walk through what that means for paper markets and how silver miners are positioned.
On the mining side, the numbers tell the story clearly. Barrick tripled net earnings to $1.6 billion. Wheaton Precious Metals posted record Q1 revenue of $901 million, up 92% year over year. And Forbes flagged a wave of mid-tier M&A that reveals something important. It's less about confidence and more about staying relevant in a reshuffled market.
To put this in perspective, we'll also look at where institutional money sees gold heading. Morgan Stanley, WisdomTree, Wells Fargo all have targets out, and ETF inflows just rebounded $6.6 billion after a record sell-off.
There's a lot to cover here. Let's think about it systematically, starting with Gold's week and the geopolitical fog still hanging over this market.
Short pause. Gold caught between two headlines this week. Ceasefire optimism on one side, active U.S.-Iran clashes on the other. That tension defined the price action, and it's exactly where we're starting today.
And the numbers tell that story clearly. Spot gold jumped 1.2% to $47.50 early Thursday, according to CNBC, as markets priced in hopes of a U.S.-Iran deal. Then it pulled back. Then it climbed again. That volatility is the whole week compressed into one name.
Right. CNBC reported Friday that spot gold was up 0.8% at $47.23 an ounce, heading for a weekly gain of around 2.4%. Two forces were doing the work there. A weaker dollar after crude collapsed on ceasefire news, and then a stronger-than-expected jobs report adding more fuel.
Wait, the jobs report added fuel to gold? That's not the typical headline narrative.
Here's why this matters. The jobs data eased fears about runaway inflation and aggressive rate hikes, so investors read a solid economy as reducing the Fed's pressure to stay hawkish. Gold benefited from that shift in rate expectations.
So here's what matters. Gold is responding to rates more than the safe haven narrative right now. Morgan Stanley actually made that point explicitly, published Friday. Their view is the Iran conflict has exposed gold as a rates trade, not a fear trade.
That's a real reframe, and it changes how you watch the news flow.
It does, because here's the important thing to understand. If gold is a rates trade, then a ceasefire doesn't necessarily kill the rally. You'd need a hawkish Fed pivot to really shake the foundation.
Now, on the technical side, FX Empire published a forecast today showing gold testing support right at 66.65. Bullish hammers forming on the chart, but price stalling below 66.80. The next downside levels they flagged were 66.52 and below.
So even with the weekly gain, gold is sitting on a knife's edge technically, and that fragility matters.
Exactly. And Bloomberg reported Thursday that fresh U.S.-Iran clashes are dimming the truce prospects. The ceasefire isn't official. The fighting isn't over. So that de-escalation premium in the gold price could reverse fast.
That's the fragility point I keep coming back to, and this is critical. CNBC quoted market watchers Thursday that the historic rally in gold and silver could resume, and I'm quoting here, as the fog of war lifts. But the fog hasn't lifted yet.
Not even close. Bloomberg's headline that day was essentially "Gold steadies as clashes dim truce prospects." That tells you everything about where sentiment was sitting.
And here's what Kitco's AM report Wednesday captured, the whiplash mechanism itself. Gold and silver rallied on the weaker dollar after crude collapsed on ceasefire hopes. One day up on peace optimism, next day pressured as fighting continues. That's the rhythm.
To put this in perspective, gold has gained 2.4% on the week despite that back and forth. That's not nothing. The underlying bid is strong.
Central bank buying is part of that, and this matters structurally. Bloomberg flagged signs of fresh Chinese central bank purchases even as the geopolitical headlines whipsawed the price. So there's structural demand underneath the short-term noise. This connects directly to what we've covered on reserve dynamics.
Which is why the CNBC piece on Market Watchers makes sense. The rally that drove gold to record highs in 2025 didn't disappear. It's paused, waiting for clarity.
Right, and here's what I'm thinking about. What does clarity actually look like in this context? A signed ceasefire? A Fed statement on rates? Both? The fog of war framing tells us clarity is the trigger, but clarity is relative.
Probably both in sequence. The geopolitical fog lifts first, dollar direction follows, and then we see whether the institutional flows come back in force.
Which brings up something worth noting. Gold captured the headlines this week. The 2.4% move, the 47.50 spike, the ceasefire narrative anchoring every note. But there's another metal that actually had an even more dramatic week in percentage terms.
And if you were watching Silver Thursday, you already know where this is going. The kind of single-session move that makes people stop and ask what exactly is happening in that market.
So what's actually driving that move? Let's think about it.
Short pause. Silver's percentage move this week made gold look downright sleepy by comparison. Not a small number. USA Today tracked the spot price at $80.32 per ounce on May 7th, up 8.98% in a single session. That's a gain of $6.62 from the prior close of $73.69.
One day. To put this in perspective, and this number deserves sitting with for a moment, a year ago, silver was trading at $33.14. We're looking at a 142% climb over 12 months.
The important thing to understand is what was driving that. The weaker dollar helped, ceasefire optimism pulled some safe haven money into risk assets, but silver also has an industrial demand story running beneath all of this.
And traders are watching $82 as the next line in the sand. FX Empire's analysis out today shows silver riding a rising channel with RSI above 58. That's a technical setup suggesting more upside if it breaks through.
The 52-week high is $117.39 for reference. So even at $80, we're still 31% below that peak.
Which means there's room. Now let's consider where this gets more complicated. While traders are celebrating this price action, Kitco published a piece this week with a statement from a U.S. regulator saying the silver market is structurally broken.
That phrase deserves unpacking. What does structurally broken actually mean?
The important thing to understand is where the concern actually centers, on how price discovery works in silver. The paper market, futures and derivatives, is vastly larger than the physical supply backing it. When you have that kind of mismatch, prices can suppress or distort relative to what actual supply and demand would suggest.
Think of it this way. If someone could sell 10 times more of something on paper than actually exists in warehouses, the paper price wouldn't fully reflect the physical reality. That's the core of the structural argument.
And here's why this carries weight. When a regulator says this publicly, it matters. It's not a fringe view anymore. SD Bullion noted this week that the gold-to-silver ratio slipped to 58, a level analysts read as silver entering a phase of underperformance. If the structural distortions unwind, the repricing could be significant.
The ratio at 58 is meaningful. Historically, it's been much higher during periods of stress. When it compresses, silver tends to close the gap fast.
Which brings us to the equity angle. Seeking Alpha covered this Thursday. As silver hit $80, the Global X Silver Miners ETF's top holdings had already been outperforming year to date. The miners are capturing the move.
Here's why it matters for investors. If you believe silver has further to run, physical exposure gets you the price, but miners give you operating leverage. When the silver price rises 9% a day, a miner with fixed costs sees margin expand far more than 9%.
That's the amplifier effect, and it's the same mechanism we've tracked on the gold side with mining equities, as we covered earlier. And Reuters published a piece today suggesting silver prices may be on a recovery road, pointing to improving technicals and the supply deficit that's been building for years in industrial applications.
Solar panels, EV batteries, industrial electronics, the demand side keeps growing while new mine supply hasn't kept pace. The structural concern the regulator raised and the fundamental supply gap are almost reinforcing each other.
Two different problems pointing the same direction, and that's the structural tension sitting underneath this market right now.
Price excitement on the surface, structural questions underneath. Worth watching both.
And speaking of who actually captures the value when prices run like this, the mining companies themselves have been reporting earnings this week. Barrick and Wheaton had important things to say about what elevated prices mean for their bottom lines.
Shifting gears to the mining sector, and Barrick just reminded everyone why high gold prices flow straight to the bottom line.
The numbers are hard to ignore here. Finami's reported adjusted profit came in at 98 cents per share against the 78 cents analysts expected. Net earnings more than tripled to $1.6 billion. That's not rounding error, that's conviction.
The Globe and Mail have the detail on pricing. Barrick's average realized gold price jumped to 66% from a year earlier to $4,823 an ounce. Production actually dipped, but the price more than covered it.
And they greenlit a $3 billion share repurchase on top of that, plus a planned spinoff of North American assets. That's a company acting with real conviction, not hedging its bets. That's a statement.
Now, flip that angle toward the streaming side. Wheaton Precious Metals had a quarter that was, frankly, remarkable on every line.
The deep dive laid out the figures. Revenue hit $901 million, up roughly 92% from $470 million a year earlier. Operating cash flow surged 112%. Net earnings more than doubled to $582 million. Does that make sense?
Here's why the streaming model matters here. Wheaton doesn't operate mines. They buy future production at fixed prices. So when spot gold runs, their margins expand without the operational drag.
And they closed the Antamina streaming deal this quarter, which resets their entire growth story going forward. New production streams coming in at a moment when realized prices are near record highs. Here's why that matters. That's perfect timing.
So both companies are printing strong results. But here's the question worth sitting with. If everything is going so well, why are mid-tier miners rushing into M&A deals right now?
Forbes had a sharp read on this dynamic. The headline alone tells you everything. Miners seek relevance through M&A as the gold price retreats. That framing, it matters.
Right. Gold pulled back from its peaks, and for smaller miners, that creates a relevance problem. They're not big enough to attract generalist investors, and they're not cheap enough to ignore operational risk.
So consolidation becomes the answer. Merge, grow the market cap, get back on institutional radar screens. The important thing to understand is this. The M&A isn't driven by optimism alone. It's partly defensive.
There's something important to understand in that divergence. Barrick and Wheaton are thriving, but the mid-tier scramble shows the market is splitting. Scale and structure matter more than they did 2 years ago.
Which raises the practical question for investors, one we need to sit with. Do you want physical exposure, streaming exposure, or equity in the miners themselves? Each behaves differently when prices pull back. That distinction matters.
And each one tells a different story about where conviction lives in this market. The producers are buying back stock. The streamers are closing new deals. The mid-tiers are merging for survival.
Those three behaviors point to the same underlying reality. Nobody thinks prices are going back to where they were. The only real debate now is how high and how fast. That's the actual consensus.
And that debate has some very specific numbers attached to it. Bank forecasts, ETF flows, and central bank buying are all pointing the same direction. That's exactly what we'll get into next. So where does all of this leave the big picture price story? The forecasts are striking.
Morgan Stanley has gold at 5,200 this year. Their thesis, per Investing Live, is resumed central bank buying, ETF inflows, and Fed rate cuts expected in 2027. And here's what I'm emphasizing. They're explicit about it. The fear trade, in their words, is dead. This is now a rates trade.
That framing matters. Gold isn't rising because the world is scared. It's rising because the structural buyers keep accumulating.
And Wisdom Tree Shaw, speaking to Kitco, goes further, 5,500 by Q1 2027, driven by central bank policy risk. So you have a range forming, and that range tells you something about how the market actually thinks about the next move.
Wells Fargo is the aggressive outlier. Finance magnates reported their call north of 6,000 per ounce. That's not a number you see every day.
Not at all. So you've got 5,200, 5,500, 6,000, three credible institutions, three different ceilings. The important thing to understand is what they all agree on, central bank demand as the structural floor.
And that floor just got reinforced. SD Bullion reported yesterday that central banks are on pace to break their gold buying records again in 2026. China and Poland are named specifically as the biggest accumulators.
Which is why the ETF story is so interesting. Yahoo Finance reported $6.6 billion in ETF inflows after the record sell-off. Institutional money took profits, gold dipped, and they came right back in. That's not random. That's the pattern.
That's not panic buying. That's a deliberate rotation back into the position.
Exactly. And for listeners trying to make sense of this week, here's the practical read. If you already hold gold, the data suggests the institutions that sold are rebuying. You're not alone in this trade.
If you're thinking about entering, the technical picture from FX Empire shows support held at 46.65 this week. Gold is currently well off January's highs. Indexbox noted on Thursday that gold is roughly 18% below that January record.
So the entry point is different now. That matters. Structurally, it changes how you think about the risk-reward.
Right. And if you're watching from the sidelines, the question is whether 4,700 looks cheap or expensive compared to 5,200 or 6,000. That spread tells you something about how the market is pricing the next move.
The piece from Indexbox flagged the inflation picture. With the next CPI report due May 12th, gold's role as an inflation hedge comes back into focus, especially with rates still on hold. That's the timing lever right there.
Here's why this matters for the broader picture. Miners are beating estimates, silver is breaking out, central banks are buying at a record pace, and institutional money just put $6.6 billion back into gold ETFs after taking profits.
Those aren't disconnected data points. They're telling the same story from different angles. And when multiple angles converge, that's when you pay attention.
The forecasts vary. The direction doesn't.
And that's where we land on the week in gold.
That's a wrap on another week at the Gold Standard. What stood out to me most was that reframe from Morgan Stanley. Gold as a rates trade rather than a fear trade. It changes how you read every headline that comes across.
And pairing that with silver's structural story, a regulator calling the market broken, that's not something you hear every day. Here's why this matters. The picture this week was genuinely more complex than the price moves alone suggest.
Right. The takeaway, if I had to put it in one sentence, is that the signals matter more than the numbers right now.
Right.
Central banks, rate expectations, and market structure are doing the real work.
If this episode gave you something to think about, subscribe and leave a review. It helps more than you know. Questions? Reach us at goldstandard@heymato.com.
Thanks for spending time with us, Sasha Reyes, and thanks to everyone listening. We'll see you next week.